Vietnam's economy is one of the world's fastest growing in the past few years. They have created a name for themselves as one of Asia's new emerging tigers. But beneath all of this wonderful news, Vietnam actually faces a significant risk that can potentially harm its economy. This risk that we talk about is no other than Vietnam's foreign reserves. Vietnam's foreign reserves, if we graph it out, has been on the rise. As you can see in the graph, Vietnam's foreign reserves grew from just $3.42 billion in the year 2000 to over $92.24 billion by 2023. That's a substantial increase in 2 decades. But despite the fact that it has increased this much, it's actually still one of the lowest in all of East and Southeast Asia. If we were to graph out the comparison of Vietnam to this region, we get to see just how small Vietnam's total reserves is. Here you can see that Vietnam has lower reserves than the Philippines, Thailand, Malaysia, Indonesia, and nearly all other Southeast Asian economies, except for the smaller countries like Cambodia, Laos, and Brunei. But since Vietnam is a major country, it wouldn't do us good to compare it to these smaller economies. So, what's the problem with having this low of reserves, you ask? Well, it's the fact that Vietnam is a major manufacturing hub. Vietnam is well known to manufacture technology products like Samsung. Vietnam is home to Samsung's largest smartphone manufacturing facility, contributing significantly to its exports. It is also a critical part of supply chains for major companies like Apple, Intel, and various automobile manufacturers. Vietnam is also known as a major hub for apparels, helping manufacture products for Nike and Adidas. Why this all matters is because there is a connection to a country's trade and their foreign reserves. You see, Vietnam is well known to manufacture and sell a lot of merchandise to many parts of the world. But at the same time, for them to be able to manufacture Samsung phones and semiconductor products, they must import the necessary raw materials or components. This creates a trade cycle where Vietnam needs a steady inflow of foreign currency to pay for these imports. Take, for example, a Samsung phone. In Vietnam, Samsung phones are largely assembled locally. Vietnam does not really manufacture everything that is inside a Samsung phone. They don't manufacture the battery, the semiconductors, display panels, or camera sensors, all of which are high-value goods. Instead, most of what Vietnam does to Samsung phones is final assembly, quality control, and packaging. The high-value components, such as semiconductors from South Korea, camera sensors from Japan, and display panels from China, are imported. This means that while Vietnam benefits from being a major manufacturing hub, a significant portion of the value generated by these products goes back to the countries that supply the core components. Here's the problem that this causes for Vietnam's overall trade, and that is its imports. When Vietnam exports something, it usually means they are selling goods overseas. That is, for example, the Samsung phone. They could be selling or exporting those Samsung phones, for example, in the United States. At the same time, they import the materials or components from other Asian countries. By importing them, they have to buy them or pay the companies that sell the goods to Vietnamese companies. And this is where we want to talk about why Vietnam's economy is at risk because of its low reserves. And it's about a metric called months of imports. Here's a graph on the total reserves in months of imports of Vietnam as compared to many Southeast and East Asian economies. Here, you can see that Vietnam is actually at the bottom of this list. For this year of 2023, Vietnam only has total reserves equal to 3 months of imports. What that basically means is that Vietnam's current foreign reserves are only sufficient to cover 3 months' worth of imports. This is a critical metric because it indicates how long a country can sustain its economy if trade flows are disrupted. The International Monetary Fund, IMF, recommends that countries hold at least 3 to 6 months of import coverage in their foreign reserves as a safeguard against economic shocks. Meaning, Vietnam is at the lower end of what the IMF recommends. In fact, if we were to graph out the total reserves in months of imports of Vietnam over time, we actually get to see that there were years when Vietnam actually had lower than the IMF recommendation. At one point in 2011, they even had only 1 month of import coverage, which was a dangerously low level that left the country highly vulnerable to economic shocks. So the risk that this poses is simply because if there were a crisis that could disrupt Vietnam's trade, investment flows, or financial stability, the country might not have enough reserves to manage the situation effectively. For example, during 2022, we saw an Asian country, known as Sri Lanka, to plunge into a crisis. If we were to graph out the total reserves in months of imports of Sri Lanka, we get to see that they had similar total reserves in months of imports prior to their crisis. But the problem with Sri Lanka is that the country had too much external debt. When a series of crises hit, like the COVID-19 pandemic, which hit tourism revenues, rising oil prices, and unsustainable government borrowing, Sri Lanka found itself unable to pay for essential imports like fuel, medicine, and food. All of this isn't just because Sri Lanka had too much external debt, but also because they didn't have enough reserves to cushion these series of crises that hit the country. If Sri Lanka had enough reserves back in 2022, they wouldn't have to face that big of a crisis where they wouldn't default on their external debt or be forced to impose harsh austerity measures that led to mass protests, economic instability, and severe shortages of essential goods. So, does Vietnam have this same risk like Sri Lanka? Well, one of the problems that they share is low reserves in months of imports. But one other problem that they don't really share is the amount of reserves as compared to the total external debt. External debt, in case you're not aware of it, is basically the amount of money owed to another country. For Sri Lanka, amongst their largest creditors were China, India, and Japan, as well as private lenders through international sovereign bonds. Vietnam, on the other hand, also has creditors. In fact, it has a lot of external debt, but of course, not as much as Sri Lanka. For instance, if we were to graph the total reserves as a percentage of total external debt, we get to see that. Compared to Sri Lanka, Vietnam has enough reserves to cover its external debt as compared to Sri Lanka. But if we were to compare Vietnam to the entire Southeast Asian region, we actually get to see that they are one of the lowest in the region, just above Indonesia amongst the major countries. As of 2023, their total reserves is 65% of total external debt, meaning that they don't really have enough total reserves to cover their total external debt. Vietnam's total reserves only cover 65% of its total external debt. While that is concerning, it does not at least put Vietnam as the lowest in the entire Southeast Asian region. But this is still a risk. Now, we have to sum it all up and see why Vietnam is at risk. The first problem that we mentioned earlier is because of low reserves as compared to both imports and external debt. This isn't really a problem, but it becomes a problem when a crisis hits. For instance, in Sri Lanka, the country had faced an economic crisis because of a series of problems that occurred continuously. Vietnam, on the other hand, has not yet faced such a crisis. But that doesn't mean that a crisis will never occur. It can occur any time. The problems that Vietnam can face are mostly related to global economic risks. Since Vietnam is heavily reliant on trade, exports and imports, then the problems that Vietnam would face is if there is a disruption in global trade, a slowdown in key export markets, or an increase in external financial pressures. For instance, if Vietnam's exports were to slow down due to some global problems, like tariffs and trade restrictions, or possibly a global recession and economic downturns, then it could cause a serious consequence to Vietnam's economy. Their manufacturing sector could face severe shutdowns, unemployment, or reduced production capacity, leading to ripple effects across the entire economy. Since Vietnam's economy is heavily dependent on exports and foreign investments, a slowdown in trade could have far-reaching consequences beyond just the manufacturing sector. Then there's the fact that Vietnam's dong, which is the country's national currency, has always devalued against the dollar. At times, the State Bank of Vietnam, SBV, which is the country's central bank, has spent billions of dollars to defend their own currency. But the SBV and Vietnam doesn't really have a lot of reserves, so they can't always defend their national currency. This would then cause the dong's value to fall as foreign investors and businesses lose confidence in Vietnam's financial stability. There are a lot of risks that Vietnam has due to its low reserves. But for now, since they still have time to ensure that these risks do not turn into a full-blown financial crisis, Vietnam may be able to take proactive steps. But anyway, do let us know what you think. Thanks for watching.